I was recently asked, David, is there a single most important factor to protecting one's wealth when investing? And if so, how can one prioritize that single thing in 2025? I will say there's probably not one single thing. I can probably give you two or three top level things that I would say to consider when making your decisions for investing in the future. One is understand what it is you're investing in. I think that's a big problem today. A lot of people have become complacent about investing. Maybe they've been disciplined about saving money, putting into certain accounts, buying certain financial products, putting into an IRA or 401k or just a tax brokerage account just to do it, to put something away. And that discipline in itself is not a bad thing. In fact, I applaud that discipline. Living beneath your means and putting away as much money as one can to potentially grow it and have it available for later retirement, whatever needs may be, that's important. But the problem is the abdication, not really knowing what people are doing. As I ask people oftentimes, well, what's in your 401k? And they'll many times give me a blank look, like they're supposed to know. We just give it to a money manager, and he or she, they just allocate and diversify for us. I think that's really not a prudent way to go about investing. Yes, you may want to use other people to help you decide where to allocate, how to diversify. That may be important for you to do. I'm a big fan of learning as much about that as I can myself. And again, that takes some time, but I think the focus on becoming your best advocate for your financial future and then utilizing outside expertise or guidance or information you may gather is a smart thing to do. Another key element in how to protect your wealth would be knowing when to hold them, when to fold them. And what I mean by that is when to take profits. There certainly have been some big run-ups, as we all know, in the last several years. Even in this last year of 2024, as we roll into 2025, it's been a big bull market in the equity markets overall. Now, unfortunately, it's been, well, I say unfortunately, not unfortunately, but it's been driven mainly by tech and by 7 major companies. Most of the rest of the market has been pretty flat. So if you take the tech out of the equation, really the market's been pretty flat in many cases. But if you've been in index fund or ETF player, you've overall done pretty darn well. And what I'm saying is when the markets are at all-time highs, as they are today, might be wise to take some of the profits and put it on higher ground. Higher ground's not sexy. It's not what we want to do to continue to compound our big returns. But if you don't know when to take profits out, in other words, when to fold them and when to walk away, then you potentially are to take the ride back down again. It's been said many times that when markets go up, particularly on a strong parabolic rise, as we've seen, the drop back to what we call reversion to the mean, it happens all the time. You don't know when. We don't know when. We don't know how much. But I think not trying to catch the very last push of the market, maybe only leaving a little bit of capital there, would be a smart thing to do. Those are two areas I think are important. The third thing I'll say, and I've sort of alluded to it in my first dictum of understanding what you're investing in, so being more educated about what the opportunities are. I believe that we're going into a decade, maybe more than a decade, where the focus should be more on hard assets, tangible assets, or we may call them alternative assets, alternative to the stock market. You can have money in anything you want to. And I think, again, diversification broadly is wise. The financial markets, Wall Street, does give us some liquidity. You can typically buy and sell. The problem is when the market is dropping down and going through a corrective mode, then you're selling into a hole and there's no one to buy as the markets go down. So having some liquidity in the stock market, some diversification there, I think it's fine. But alternatives give us a better chance to be more specific about our investments. It is an inefficient marketplace, which means there's more opportunity for us as individuals if we're willing to do the work or gain the access to the network, the people, understanding the due diligence. There's more opportunity there, I believe, particularly in the next decade ahead. So word to the wise, understand what you're investing in, know when to take chips off the table, and probably think about becoming a more active orchestrator of your financial future than you have in the past. People know that I have a bias towards more active involvement in one's financial future. And my bias means that I do speak out oftentimes against the abdication or complacency of just putting money in the traditional mode of the Wall Street financial retirement model, the IRAs, the 401ks, the tax deferral, that for a number of years recently, so recency bias, looking back in the last few years, maybe the last even decade since 2008, we've seen, a great rise in that marketplace. So if you've been there, then congratulations, you have done well. And you could say, well, David, you've been wrong. I've actually done quite well in the alternative space and feel very good about that. I do put time and effort into it. And I also believe that as the markets shift and change, particularly the equities markets in the financial arena, Wall Street, as they change, go through a correction, it's going to leave a lot of people kind of holding the bag and wondering, well, where do you go next? What next? If you haven't studied the markets and studied alternatives and made access points into where to maybe take some of your capital, take some profits, and move into other places where you can hedge against downside risk, then I think you're making a mistake. And many people just won't heed that advice. They look back and say, well, if the market's done this already, let's put more in. It's the fear of missing out, the FOMO, the greed that drives people. And it's a human behavior. We all have it within us. I think just finding the ability to have the discipline and the knowledge base to know when to hold back or when to reallocate certain investment capital so that you don't take those big losses, the big corrections when they come, because they will come. They always do. The last one, really 2008, short one in COVID spring of 2020. The next one, I think it could be a big one, and you just don't want to get caught short. Understanding where the alternative investments are and how to access those, I think, will be a big key for people going forward in navigating and maintaining their financial freedom in the years ahead.